to analyze a company for buying shares or stocks. In case you're new to my channel, I give you updates on economy. I also teach subjects on civil services preparation. But today I'm going to give you an investment advice on how to analyze a company when you buy its stock or share. The five key elements while analyzing a company to buy stocks or share are the following. The first is its general long-term prospects, its management, its financial strength and capital structure, its dividend record, and its current dividend rate. So these are the essential things that you must look while buying a stock or share of a company. So let's look into the long-term prospects of a company. How would you identify a long-term prospect? One of the important thing is you should look whether the company is a serial acquirer of business. In case if it is acquiring a lot of business, then the company is a big no. You should not buy its stock because we know there is something wrong with that company. The next red flag to look into is borrowing. The company should not be borrowing too much. The other thing is how much customers the company have. If the company is selling to only one customer or one big business, then that is a big no. Now these are the negatives that you have to look in and be wary of before buying the stocks. Some of the positive aspects of the company or its brand identity. For example, if a company like Coca-Cola or Pepsi, which has a huge brand identity and a brand following, then you can buy that company because the customers are going to be loyal to that company. And also look at the monopoly. If a company is the only player in the market in its niche, then we can buy that company as well. And the economies of scale. When I say economies of scale, you see how large the company operates. For example, something like Gillette. Gillette sells cheap razor blades to a lot of people. Something like toothpaste, Unilever are good examples. So if a company is operating in a huge economies of scale, then that is a good sign. Also look for its intangible assets like the intellectual property, copyrights, patents, or design ideas. All those things are also a good positive aspect to buy a stock. The next important thing is a consumer's resistance to substitution, which means a consumer has no other substitute product for the product the company is offering. So these are the long-term prospects of the company. Like if a company's got a good brand identity, monopoly, economies of scale, and an intangible asset, all these things are good prospects. You can go ahead and buy the company. On the other side, if the company is borrowing too much, it has a big debt, it is not serving to a huge customer base, or if it's a serial acquirer of business, then you must be wary of buying its stock. The next important thing is financial analysis. So when you do a financial analysis, what you should look at the most important thing is whether the company is growing smoothly or steadily for the past 10 years. It's not like the company grows suddenly for the past 2 years and falls, which means the growth is a transitory one, it's temporary, and it's not going to last. So you should look at the last 10 years and see whether the company is gradually growing smoothly and steadily. The other important aspect also you should also look is how much the company is spending for research. A good potential company should spend at least 4% of its income on research. It should research the markets. It should come with new products. So these are the important aspects you should look in finances. The most important thing is the company should go smoothly and steadily for the next 10 years, for the past 10 years. The other key pillar of company's assessment is management. When it comes to manager, look at their forecast. If a manager is forecasting certain uh, growth level for a company, look at their past statements and see whether they have fulfilled their forecast. If that is not done, then we all knew that the managers are just giving low stocks, and those talks where they are trying to be attractive. The other thing is to look for is whether the manager is paying themselves extremely high. The top positions of the company, like CEOs, managers, look at their salaries. If the salaries are high, then it's very well that the company is not going to serve their customers but only their masters. The next thing is reusing of stocks to insiders. This is a big red flag. So when a company is reusing stocks to insiders, it usually means it is starved of cash. So look for those signs, and also look for big sales from the company. Uh, a a big sales here and there is fine, but if it is happening frequently, then we must look and delve deeper into those aspects. Another important thing is the financial strength and the capital structure of the company. We must look at its earnings per share. The earnings per share should be 6 to 7% consistently over a long period of time, say for 10 or 15 years. And its long term debt should always be under 50% of the total capital. The other important thing is whether the long term interest rate is fixed or variable. When you see the long term interest, long term debt, you see whether the interest rate is fixed or it is varying. This helps you into analyzing the interest rates much better way. But the most important thing is it the company should generate more cash than it consumes. If the company can generate more cash than it consumes, then it's a good indication that the financial strength of the company is good. So these are the important aspects that you have to look when buying a stock of a company. If you like this video, do share it and like this video. And until next time, it's bye from me. I'll post a lot of videos on economics and other topics.